Most physicians are great at making money, but terrible at growing it. You can work 60-hour weeks while your savings sit in accounts earning basically nothing. NURP changes this. It's algorithmic trading designed specifically for busy professionals who don't have time to watch markets. AI-powered strategies that work while you're seeing patients. No day trading, no guesswork, just systematic wealth building designed for people with demanding careers. Built for physicians who want their money working as hard as they do. Check out start.nurp.com/doctors. That's start.nurp.com/doctors to learn more. NURP is a paid sponsor of this episode. All trading carries risk and results vary, so do your own research. This is not financial advice. Welcome back to Healing People, Not Patients. I'm Dr. Jonathan Winkle. This show is built on a simple, stubborn idea. Medicine is a relationship, not a transaction. We care for people best when we treat them as people. So you might be surprised by today's topic, money. But the truth most of us don't say out loud is that a physician who's financially exhausted, trapped, or afraid isn't free to practice the kind of medicine they believe in. Financial precariousness is one of the quiet engines of burnout and moral injury, especially for doctors like me who choose to specialize in a lower-paying primary care field. The difference in income between that and a better-paying specialty can be so stark that medical students with high debt burdens often rule out primary care even before they really think about what they want to do. It can be so stark, in fact, that might keep somebody who's a first-generation aspiring doctor out of the field altogether. Autonomy over your finances can be, in a real sense, autonomy over your calling. There's a saying in the nonprofit world, no margin, no mission. It fits for organizations, but it's equally true for private individuals. A doctor who has to depend on their career for their entire livelihood might be stuck providing volume-based care that doesn't leave room for relationships. They might be stuck charting in their pajamas. And they might be stuck providing care that they know is wrong because of how it's incentivized to promote particular treatments over the well-being of the patient. Having a little bit more financial freedom can give us the ability to say no to the wrong job, the wrong environment, or just something that's plain wrong.
No room for the soul that's in my head. No room for the soul that's in my heart.
When someone's sick, they're not just dealing with annoying symptoms. They're confronting some of life's biggest questions. I'm Dr. Jonathan Winkle, and you're listening to Healing People, Not Patients. Join us as we explore how to make our practice about complete healing, healing of the body and the spirit. Welcome back to Healing People, Not Patients. My guest for today's conversation is Jeff Seckinger, founder of NURP, an algorithmic trading company with a fantastic name. Jeff's built 3 companies in finance: 0%, which is in financial education, Orca Capital, a digital asset hedge fund for accredited investors, and NURP, which licenses that strategy directly to individuals, like you and me. Full disclosure, this is a sponsored episode and NURP is a partner. I agreed to it because I think the conversation about physician financial well-being is worth having. Also, a disclaimer. NURP is a software and financial education company, not your financial advisor. Nothing we discuss is financial advice. It's an invitation to think and to investigate, not a recommendation. Anything that touches your capital deserves careful due diligence, just like anything that touches your health. Trading carries real risk, including the risk of loss. Jeff, welcome to Healing People, Not Patients.
Thank you, Jonathan. Love the intro.
I like to make it fun. So I did mention in the intro, you built 3 financial companies, 0%, Orca Capital, and now NURP. I imagine there's a through line. There's some human problem that you're trying to solve. What is that?
Yeah, really trying to give freedom back to the individual. I feel that when I went through traditional education, there was a lot of important things that were left out. I was shocked that I didn't learn how to increase my credit score or how to file my own taxes or how to properly invest money. I didn't learn about modern portfolio theory and the efficient frontier and the things that actually matter to set you free later on in life so that you can pursue the things that you are passionate about or spend time building your family or business or whatever it may be. So yeah, that's the primary mission for myself. It's just helping people create a little bit more freedom so that they have the ability to do what they want to do here on earth.
For sure. I can resonate with that from my medical education where they never taught you how to solve a dispute or how to bill correctly for the services you're providing. So I hear you. Now, Orca Capital was a sort of more traditional financial services company for accredited investors, the people who already have access. NURP, as I understand it, is opening up that same strategy to ordinary individuals. You're showing me your values in that choice. I chose to practice primary care in a place that would serve patients without regard to their insurance status. You're sort of opening up investing to people who don't have the financial expert status. Why did that matter to you?
Yeah, because I feel that the laws are the laws first and foremost. So typically they're the way that they are for a reason. But I found that it's a hedge fund is what Orca Capital is. And there's a requirement to be accredited, which is $1 million or above net worth. There's also income limits if you don't meet the $1 million mark. But we have another fund that is under Orca Capital. That's a management company. It manages multiple different funds. That is a $5 million net worth. And then there's different products that are a $10 million net worth. And
I'm further and further away from my reality with every word you say.
Yeah, exactly. And that's what I found is there are a lot of people that are working hard to get on the path to whatever their goals may be financially, but they're not quite there yet. So there's a big gap in the market between someone that's maybe worth a couple 100,000 or just approaching $1 million or maybe 2 million, and they can't get into the next thing, the next best product, which most people are not able to get into because the reality is most people are not worth 5, 10 million plus. But when you get to that mark, I saw it in the bank as well. You get offered special types of structured products. You get different types of deal flow of different investments that you could make that are very advanced that could dramatically change the trajectory of your financial life. So I wanted to do something where I can help the person that is actively pursuing the path to financial freedom that is somewhat on their way, but help them expedite that as well. And hopefully teach them a thing or two along the way. So NURP doesn't take custody of anyone's money. It's not an investment fund. We don't charge performance fees. It's nothing like a hedge fund. We just build technology that allows the individual to license really like an institutional grade software in their own brokerage accounts. So we're a licensing company. We're not a fund. We're not an investment company. We don't manage anyone's money. So there is a major difference between what the fund is doing, how the fund operates, and what NURP is doing and how NURP operates.
So that actually leads directly to my next question. You've described sort of the 3 pillars of NURP as capital preservation, verified performance, and investor autonomy. And that what you were just describing is very much in the autonomy bucket, which is what interests me the most. That's super important to my patients as well, sort of being able to be in control of their health and not be railroaded into stuff. And I know what that looks like in clinic. So what does that autonomy look like for investors in practice with what you're doing?
Yeah, the main thing is what I found that there's huge benefits to trading. And trading is different than investing. Investing is placing money in an asset and waiting for that to appreciate. Trading is extracting money out of the market. So you can make money when the market's going up, down, or sideways. And what I found is when I'm trying to do something, it's generally best to learn from the absolute best in that industry. So if I'm trying to learn basketball, I'm probably going to go study what Michael Jordan did, LeBron James, Kobe Bryant, right? You're going to look at the best people. Now, in investing and growing your wealth, most people think that the top investment manager of all time is a guy named Warren Buffett. Everyone's heard that name, right? Everyone knows who he is. And he is exceptional. But what is funny is most people don't know that he is not the most successful. In fact, there's people in the industry that have doubled his performance and been more consistent, such as a guy named Jim Simons that ran a fund called the Medallion Fund. They averaged 66% a year for 30 years. And there's a book on him if you want to go read more about him, named The Man Who Solved the Market. And Warren Buffett did 20 to 30% a year. Jim Simons more than doubled or tripled what Warren Buffett had done over even a multi-decade period of time. So I studied what the most successful funds were doing. There's also another company named Jane Street that's making $5 billion a month. And they're doing like $3.4 billion in profit out of that $5 billion. So they're actually one of the most efficient companies in the world. So I'm like, man, what are these guys doing? And what they're doing is they're building trading systems into algorithms. So they code it using software, and then that software executes a predefined trading strategy. And they have dozens and dozens, if not hundreds of different strategies they're running at one time. So they are very advanced and complex. But what I found is that type of relentless compounding that they are achieving is the top investment tool in the entire industry. And it's just proven by facts that those companies are the most efficient and the most profitable that really the world has ever seen. So set out on this journey about 4.5 years ago to say, hey, how can we do this not only in our own institution to compound our wealth for our investors in a fund capacity, but also how could we potentially open this up to people that maybe either don't meet the net worth status or they are just at the place where they want to get access to some type of technology, but they don't want to give up their custody. So we program some successful trading strategies into softwares and people can license that in their own brokerage accounts. The autonomy is that they don't need to sit there to learn how to trade because only 96 to 99% of people tend to lose money over multiple years trading. It's just a fact that you
like this, the house is always going to come out ahead.
Exactly. But it's almost worse when you think about the odds. I guess maybe if you put money on black or played blackjack for 2 years straight, you would probably have a pretty terrible odds of winning. But trading is pretty similar, although there are ways to put the odds a bit more in your favor. And that what people don't realize is, there is huge benefits to trading, which I can go into, but there's also major drawbacks. So the software takes away a lot of the major drawbacks, such as staring at a screen all day, waiting for a setup. If the setup doesn't come, a lot of times you get impatient. You emotionally enter that trade before you should have entered that trade. You don't have time to go keep working on your practice or spend time with your family and friends. A lot of the times you're just learning a strategy online or you're in a group and someone's saying, hey, buy Tesla and sell it at this price. And you don't realize that they actually haven't back tested that strategy. They don't know that actually would have worked over the last 5, 10, 15 years. They're just guessing because, they learned about a head and shoulders pattern on YouTube and they think that's going to be profitable. And maybe it was profitable last month, but now it's not going to be profitable the next 3 months. So they don't have something called positive expectancy, which means that the strategy actually makes money because they never spent the time and energy to code it and backtest it. So the autonomy just gives them control of their account. They are in control of their own brokerage account. They can deposit and withdraw at any given time. And they're leveraging a strategy that has, at least historically, positive expectancy, meaning that the strategy has worked over long periods of time.
Sure. And the medical professionals listening can pick out of the last 2 minutes of what you've been saying, all sorts of cognitive mistakes that we make in practice and research of like, this new surgical technique's going to be great. I'm going to start using it on all my patients without ever doing the study to prove that it's better. So
a great example. Yeah.
Speaking of my audience, there's a lot of people who are listening to the show about getting your soul back into medicine and doing it for the reasons that we wanted to do, most of which had nothing to do with making money. And so I want to make sure that we're addressing a lot of those values-driven physicians in the conversation that we're having. A lot of us are uncomfortable even talking about money. It feels like it's, at odds with our whole essence, our whole reason of being. So when somebody like me, who, as I've mentioned now 3 or 4 times, doesn't love talking about money, when I finally reach out to NURP, what's the most common blind spot, cognitive error, like we were talking about, that you can see in how we've handled our finances up to that?
Yeah, I mean, we have over 3,500 clients that are around the world, and a fair amount of them are in the medical field as well. So I'd say the biggest blind spot is a lot of the times just too much concentration risk, which is where you have too much of your wealth in one bucket, which oftentimes that's in your practice, or it's like only in the equity market or only in real estate or only in bonds. And when a difficult time happens where the market is maybe just chopping sideways for multiple years, or we head into a bigger bear market like '08 or the tech bubble, 2001, 2002, it becomes quite difficult to watch pretty much your entire investment go down by 50% plus. And that's just reality. That does happen. There's cycles in the market. Typically, just the stock market in general goes up for 15 to 20 years. And oftentimes it goes sideways for 10 to 15 years. If you look at it over long periods of time, that's generally the cycle that it goes through. And we have been just on a roaring bull market. So if you've been in the equity market, you've had a lot of fun especially the past 2 years. But people forget about also the bad times and the importance of diversification. And the same thing goes with your business as well. If all of your wealth is in your business and you make no other outside investments, you still have concentration risk there as well, because there's big ups and downs in business as well. It can be very difficult. And that's just the reality of business. So I'd say that's probably the number one thing. And then a lot of the people that make investments, especially when you get into alternatives, because really what we offer is a way to get into alternative investments. And I could go into the reasons why alternatives are important, but the piece that I want to touch on is that when you're building out a portfolio, it is important to have different assets that are uncorrelated to each other, so that if one is going up, another one may be going down. If one's going down, another one may be going up. So it smooths out the equity curve of your investments over time. Our technology would fit into the alternatives class. And the great thing about what we do is you're in control of your own account. Yes, the strategy does 99% of the work, but you're in charge of turning it on and off and setting an equity monitor and just some small settings. It comes with default settings, but you have little things that you can adjust. And the great thing about it is you have liquidity, which means that when you put money into the brokerage account, you could put it in on a Monday and take it out on a Wednesday. Most other alternative investments like private equity or venture capital or private credit, you would be putting that money in there. And oftentimes you don't see it for 3, 5, 10 years because they're putting that into a business. They're loaning that out to other companies. They're putting it into real estate, and those things are illiquid. They take time. And that's the huge benefit to what we do is you have your own liquidity. You can pull it out at any given time that you want. And I would say it solves a big blind spot of just that concentration risk. And also the great thing too is like when you start to see some profit in the account, you can just take it out whenever you wish. So it can kind of like supplement someone's income. I don't think it's a great thing to just say, oh, let me sell all my businesses and only do this thing, because then you're back into concentration risk.
Right.
But again, it is a great supplement to like an overall investment portfolio and like an income diversifier.
Sure. And, in that pool of people that I was talking about, a lot of us are also not business owners, right? The area of private practice in medicine is dwindling if it's not fully over. There's very few people, businesses of that kind. It's all consolidated into either the private equity firms or into the large health systems. And I work in a nonprofit. So a lot of us are getting advice, something like max out your 401k or your 403b because you're an employed physician, buy some real estate on the side and hire a financial advisor. And it sounds like you're saying that playbook is inadequate for 2026, especially for somebody who wants to be able to continue being an academic physician and not have to worry about the fact that, academia pays less, or being in a nonprofit that pays less. We can do that with full integrity and feel great about the work we do and have a source of income that's outside that space, not consolidating everything and just into that salary.
Yeah. Yeah. I think it's important to have like some retirement accounts where that grows tax free. It really just depends on an individual's goal. But generally in your retirement bucket, you do want safer types of investments that have worked for 100 plus years, because that's really like your nest egg. That's the thing that you're going to end up retiring on. And it's hopefully going to feed you when you don't have the ability to work anymore. You don't have the desire to. So I think it's important to keep that bucket and to, yes, contribute to it and work on making smart investments in there that are relatively low risk. Like index funds are great because they do just automatically replace the investments in there. So they're like an actively managed advisor essentially, because if you're in the S&P 500, it's always really the top 500 companies in the US. So when one starts to kind of die off, they kick the company out of the index and they replace it with a new one. And knowing that technology and AI is going to keep growing, my personal opinion, and by the way, I was working for JP Morgan and was on my path to being an advisor in the private bank. That was my stepping stone that I was working towards. And I was really helping those private bankers manage their accounts for all their investors. And that was my next step. And I was like, what I see in the industry right now is technology is rapidly changing. There's all these robo advisors, these new index funds that are relatively low cost, and they really are kind of actively managed because of what I just mentioned. So what is the point of the advisor? And a lot of the times the advisors are just really taking unnecessary fees that you really don't need to be paying. It really depends on the complexity of your situation and your goals. Some people may need an advisor because they are a bit more complex. But if it's very simple, you believe in AI, you believe in technology, and you believe in the United States economy, it would make sense to kind of just dollar cost average in a retirement fund, an AI index, a tech index, and the S&P 500. I think you do quite well there. But outside of that too, I also believe that we've got a lot of people that do use Roth IRAs to use our product. So they set up the Roth IRA with the brokerage account so that they can kind of grow that tax-free. But I think it is important to have the majority of your assets in something safer that compounds over time, that's proven over 100 plus years, like I was saying. But also, even just outside of retirement, I think it is important to make other types of investments that aren't sheltered in a tax environment. Because if you ever need that money, by the way, you're paying a big penalty. You're paying the taxes, then you're paying a 10% penalty. And I really believe that it's important to be building a portfolio outside of retirement accounts. And inside of that portfolio, there is a lot of opportunity to have a bit more upside than like the safer things that you're doing in your retirement account. And that's how I would really think about what we do. Is it's generally built for investments outside of retirement accounts. You've already got your core piece of your portfolio. It's going to grow long-term. You partition off, let's say, 2 to 15%, whatever it may be, to make some alternative based investments. Maybe it's gold. Maybe you have a little bit in like a private credit or something. And then you can have a piece in a brokerage account where you're deploying one of these strategies.
Sure. The 401k or the Roth is your vaccines to keep you from dying in the pandemic. The more sort of risky investments are you're going to the gym and pumping iron for 2 hours so that you can win whatever strength competition you're entering next weekend. I get the difference. So we talked about the particular link between financial stress and physician burnout and moral injury when I was going through my introduction. I feel like that secure foundation that we started to talk about might change somebody's ability to be present with their patients, to say no to the wrong job or decline to engage in some kind of questionable business practice, basically stay in medicine for the right reasons. Have you seen that happen with your clients?
Yeah. In regards to them just being doing things that are outside of maybe their risk limits or.
Yeah. But also being able to just say, you know what, the noise of worrying about my financial security is set aside. And I can go to work knowing that I'm not going to agree to every crazy thing, every budget cutting measure, every whatever I'm being asked to do. I'm going to practice with integrity. And if I have to say no to something, that means I've got to, look for another thing. I've got the security to do that and really define my own path in medicine.
Yeah, totally. I think there's a huge, really just not only financially, but a huge just boost to your energy when you feel more empowered and in control of the direction that you're heading, and you see a clear path to getting to where you want to go. That's a really exciting part of life to be in. So that's what our product does. Again, we've had quite a few medical professionals that have different types of med spas and things like that. And they're just always on the grind, always building that next, medical business. And they get really exhausted doing those things over and over again, and having to grow a company that has the ups and downs. And in their career, there's major ups and downs. And what I found is that they felt very empowered to have another source of income and another source of investing outside of their financial advisors. So yeah, I would totally agree with you. There is a big shift once you feel like you're a bit more in control and you feel like you're heading in the direction that you really always wanted to. It's just hard to find the vehicles to help you get there.
Yeah, I can hear that. So there's obviously a caveat, just like I don't want my patients coming in and just accepting my advice face value without asking questions. A lot of physicians have gone through the kind of paternalistic model for the last decades. And I'd say in the last 25 years, we've really started to learn to be collaborative with people. And the activated patient, the one that asks questions, is actually who we want to be working with. So we're going to be thoughtful consumers now and say, you're a sponsor. Super grateful that you guys have believed in my podcast. But I want to examine carefully what we're talking about because a lot of my listeners are going to have questions. I do want to put a pin in what you said about the AI versus the human advisor. We'll come back to that in a little bit. But I want to start with some things that I've heard murmurings about with algorithmic training, which is that there is a credibility problem that's not unique to trading, but a lot of the AI space, whether it's in medicine, whether it's in finance, whether it's in logistical management, a lot of it trades on hype. And some of us feel like there's been a lot of false promises. So the platform gets kind of out over its skis and we end up with underwhelming results or even dangerous results. So we're a careful, skeptical physician like me or like a lot of my listeners who don't want to compromise their judgment. What's the way to examine and do our due diligence on a company like yours, on a company like NURP?
Yeah, I think the main reason why you're often working with us is because the product works. So I think the main thing to do is to verify the track record because we're not going to really sell a product that doesn't have some history to it. So we do that in multiple ways. There's a third party called MyFXBook that connects for brokerage accounts. So we give it the account number and an investor password, and it pulls all the data from the brokerage account and then shows you every single trade that it's made and whether it lost money, whether it won money, what the win rate is, what the growth curve of the account was over time, what the worst day, worst month was. You can see all those analytics and it's verified through a third party. Now we also took brokerage statements and sent it to another third party. And that third party also gave us a report back that says, yes, the data on MyFXBook is accurate. And our analysis verifies that those performance numbers are correct. So we've had it double verified in that sense. And then also there's a way to test the system before you even buy it, which I think is a great feature that we've offered. And that's what we're going to be doing with you, by the way, as well. If you want to just test the system over the next 90 days, you can do so. And it's really just on something called like a demo, like paper traded account. So you're essentially running a normal account. You're connecting it to the software. And instead of you putting in real money, it's fake demo money so that you can just watch the algorithm function and you can watch how it trades. You can see if it's positive or negative and what it's doing over time. And then you can get a feel for, okay, yeah, there are some ups and downs, but overall it's more up than down. And this would make sense. And here's how I would adjust my own settings if I want to be more aggressive or less aggressive and more conservative. You get a feel for the platform. You get a feel for how it works. So I love when people start, small, or they start kind of with that demo in mind, and then they get comfortable with it. And then they start to actually place real money in there and watch it grow over time.
Gotcha. I feel like there's an opportunity there, which unfortunately you can't do because of copyright infringement. Like you should call this monopoly NURP. Fantastic. That's a really great thing. We've just started to see people being able to kind of watch videos of or do like a little VR test out of a medical procedure, something like that, so that you're able to understand what you're getting into before you get into it. That's a really great feature. I like that a lot. I also like that you have watchmen watching the watchmen who are watching the watchmen.
Yeah, it's important for
a lot of redundancy in the security there. That's helpful also.
Right.
So you've kind of already done what my next question was, which is walking us through the structure to protect people. And I will award you extra points for doing it in plain English. This is what I make my med students do all the time, to remember to speak like normal humans to a patient so that they're not confusing them more than they're helping them. The one piece of the structure to protect people that you didn't talk about was there was something that was in your materials about the capital staying in the person's own brokerage account and having API only access. So can you translate that back into terms that a simpleton doctor like myself can understand?
Yeah, totally. So it's similar to you like opening up a broker account with, let's say, Charles Schwab or TD Ameritrade or one of those typical brokers that you have your retirement funds with. And inside of that company that you have put money into, there's different account numbers. So you would have a certain account number for a retirement account. Maybe you've got another account number for another investment account. And ours is pretty similar to that structure. So you're opening up a brokerage account. That account is under your name. The only person that's in control of those funds is you. Now, what you do is you deposit money into that brokerage account. And now all you're doing is you're licensing the software. You're giving the software access to just place trades so it can open and close trades. That's really all it can do. It can't withdraw money out of your account. The only person that can withdraw money is you. There's no advisor. There's no person that has access to your account. You in the platform license the technology into your own account, and then you can adjust the settings that the technology is doing inside of your account. So that's the major difference. It's not like a fund. It's usually pooled together money. So if you were coming into a fund, Jonathan, you would be investing money with other people into the same account. That's not what we do. All of our users have individual accounts, and then they license the technology into that individual account.
That makes a lot of sense. So one of the things that you said, we've got to look at these is these are not the bread and butter, like tried and true for 100 years investments that you're using for your nest egg. There's a little bit more risk, high reward products. And so we do have to talk a little bit about the losses if we're going to be completely honest. I don't know what Midas is, but I understand from talking to the folks on my network that they've verified a pretty high max drawdown of about 26% on your platform. I don't totally understand the concept, but that seemed like a very high number to me. So can we talk a little bit about how you would address that number and how to kind of talk frankly about it? I'm saying you need to have this surgery. There's a pretty high risk of complications with that surgery and not shying away from it, which I will be honest with you, a lot of doctors end up doing. They kind of soft pedal the risks. So don't be like that. Hit me hard and talk to me about what the risks are and how we avoid them.
Yeah. So that's our default track record. So this is all public information that's online. You can view the track record, which has been from February 17th of 2025 until obviously now in June of 2026. You can see the live account that's grown over that period of time. And what matters is really the ratio of the performance relative to the drawdown. There's all different types of terminologies that you can look at to kind of identify if a strategy has a strong edge in the market, such as like a Sharpe ratio or a Kalmar ratio or a Sortino ratio. And I won't go into all those things because you can look them up on your own. We don't have 4 hours here, but what is important is what type of performance have you had relative to the drawdown? So what drawdown is, how much has your account gone up by? And that is like whatever the peak is, whatever the equity has come down by after reaching that peak is the maximum drawdown. So the amount that the account, let's say the account went up 100% and then it came down 20%, your maximum drawdown is a 20%. So that's what that means. Now, that happens across pretty much every asset that you invest in, unless you're in like a certificate of deposit and you make 2% a year that has pretty much no volatility, right? Anything that compounds at 5, 8, 10, 12, 15, 20% a year will have generally more volatility. But what matters is what's the performance? So the gains relative to the drawdown, which can be seen as an unrealized loss. Sometimes it is a realized loss, meaning the trades were closed at a loss. So yeah, the system is definitely not absolutely perfect because guess what? Nothing on earth is. But what's important is from, and I did these numbers actually yesterday, is from the beginning of the track record, which again is, February, the second half of February of 2025 until June of 2026. I compared it to gold because it trades gold. So Midas only trades gold, the asset of the precious metal gold. Over that period of time, from February of 2025 until June of 2026, gold has had a maximum drawdown of 29.18%. Gold has actually come down by more than what the algorithm has The algorithm has had a maximum drawdown of 26.42%. Now, what's important is, okay, those numbers are relatively close. Obviously, gold is a little bit higher than what the Midas strategy has come down by. But what is important is the performance is dramatically different. So over that same period of time, gold is up 36.4%, which is great, but Midas is up over 500%. So the performance that was achieved with that maximum drawdown is really exceptional because it's all about how much performance do you have relative to how much drawdown you have had over that period of time.
To me, like you're describing the difference between having good days and bad days, or good weeks and bad weeks, where you hit a rough patch, but if you stay the course, you end up in a much better place over the long haul.
Exactly. Yeah. There's always ups and downs in every investment and every trade. That's just reality. That's just the name of the game. You see that in your stock portfolio too, right? When the tariff news came out, everyone's stocks went down to 18% and everyone's like, oh my gosh, what's happening? And what happened? It came back and now we're well into new all-time high. So the strategy goes through those periods where it does come down for a bit. It has a losing month. Generally, it has 2 to 4 losing months a year. It's not a perfect system. This year, it actually hasn't had a losing month yet. But what matters is the reason why I was talking about that
ratio. Do
ratio.
something superstitious before we go on. You don't let the announcers jinx yourself.
Yeah. And I think what I was saying with the ratio that's important is if you wanted to be less aggressive, let's say you don't want to aim for really high numbers and you don't want to see your account come down by, more than, let's say 10%. You could lower the position size that you're telling the algorithm to take. It's one click of a button and you change 2 numbers and the algorithm changes how much money it's putting into each trade. If you wanted lower volatility, you wanted a lower drawdown, you didn't want to lose as much on the downside, but you're also giving up more of the upside, you can just adjust one setting and bring down your risk substantially. You could also just change an equity monitor. So let's say you don't want to risk more than 10% of your account. You can set your equity monitor to 10%. So if it ever does come down by 10%, the algorithm closes all the trades, stops trading, and sends you a notification to your email. And it will not turn back on until you go into the portal and actually turn it back on. Okay. So those are the key features that are really important. And that's why I say, the ratio is what matters, because at the end of the day, the user can adjust those few small settings that change the amount that was the drawdown happened, or change the amount of upside that you have.
So one of the things that I've been thinking a lot about recently, you talked about sort of the move from the human advisors to this algorithmic type of model that you're using, is sort of where ultimately it's going to shake out that a human brain and a personal relationship is best. That's the best way to work things out, and which things we kind of turn over to an algorithm. What wasn't part of my planned conversation, but I'd really like to know, where does the human being, other than the customer, still remain in this, in terms of you and your team that are looking at this algorithm and adjusting it? Somebody who can talk to somebody like me who's trying to use the algorithm and is like, I'm setting these parameters, but I don't actually know what I'm doing and I need somebody to guide me. Where is the person still in this, and where do you see them sort of remaining active in a relationship with your customers?
Yeah, that's a great question. And you're talking about specifically to our products, is that right?
Yeah, specifically with NURP. I mean, if you have a grand vision for where human financial professionals are going to be in the brave new world of algorithmic trading, sure. But I'm really interested in hearing about what NURP is doing in terms of retaining the human element in the relationship.
Yeah, that's a great question. We have something called relationship managers, which is where you have a one-on-one contact that you can go ask questions at any time. So when you log into the portal, there's a link that you can click to even book a call with them at any given time. And then obviously we have, 24/5 support through email, text, all that. So there's, if
the markets aren't open on the weekend.
Yeah, you're right. The gold market's not open on the weekend, but also our employees take a break over the weekend too.
That's a huge win for humanity that you have a real actual 2-day weekend in the finance world. That's amazing.
Yeah. And you're not
I'm a Sabbath observant person, so I'm 24/6.
Oh, okay, great.
But you've gone me one better. So
yeah, I think it's important for obviously people to have breaks in their lives. So, and it's also important that you're not talking to just an AI chatbot. People want to be speaking to an actual human that can answer the more in-depth questions. So yeah, I have a specific product team that we focus on building the systems that actually do the trading. So we build the algorithms, and then we are watching how the algorithms performance is happening in real time. If we see the market is like changing dramatically and things need to be slightly adjusted, that automatically takes place. So the algorithm is growing and changing over time. It's not just a static model that always stays the same. That is something that the user doesn't need to do because that is growing and changing over time. But I think is a really key part of our company culture is just empower people. So we make sure that they're educated before they actually start to use the system. So you should very well understand how the system works, how the portal works, and then really like the 3 different settings that you can adjust. Everything else, there's default settings for. There's only a few small things you can adjust. So it doesn't take an exorbitant amount of time. You don't need to turn into a mathematics professional to understand this quant model that the strategy is trading. It's generally pretty easy to understand. And we've done our best to make that like speed up the learning curve to get the benefits of trading without all the drawbacks that you would generally have.
Got it. So to bring us home, for somebody who's listening and wants to look at this more carefully, see the verified numbers, understand how it works, you kind of gave us this information, but refresh our memories. It's been, 25 minutes already. Without putting anything at risk, what's the gentlest first step for them to see NURP in action?
Yeah, I think the best thing to do is to go into that demo environment, which is where it's like the paper traded account. Everything should function very similar to a live account. So if you were to put money into an account or you were to run a demo account, the performance should be very close to each other. You can't say 100% the same because sometimes live trading environments can be slightly different. But the demo account does its absolute best to mimic what the live account is. And the cool thing is, again, all of our track records are public. You can see all those numbers, every trade, it updates on a daily basis. So you can literally see day by day what trades it's made, how well it did, how bad it did, the winners, the losers, everything. So the great thing is you can come into the demo and then you can watch our live public track record and you can say, oh, wow, my demo is doing almost exactly what the live track record is doing. And you can monitor those 2 things and kind of compare. So there's a link below in this recording that I believe the URL is start.nurp.com/doctors that you can join the demo. You can click on that link or type that in and you can get started with a demo account and just see how it functions.
Yeah. That's great. And I got to give you credit for that level of transparency. People have been fighting in the medical profession for decades to get hospitals to be that transparent with their outcomes. I'm very interested to hear that.
I never thought about that. That makes a lot of sense.
So Jeff, I really appreciate the honest conversation. This is the first time I've worked with a sponsor and I was willing to have this conversation because this is an important part of self-care. I don't love the word self-care. It brings to mind a lot of woo and a lot of juice cleanses and things like that. But caring for yourself financially, just like maintaining relationships or having, spiritual interests, those kinds of things, is part of being able to care for others. And if you're not taking care of the vessel, it's like not putting on your oxygen mask on the plane. And I'll credit you for having a structure that keeps the investor in control of their own money, that lets you verify the performance like we just talked about and stay in control of your decisions. Just like I try to help keep my patients in charge of their own decisions and not railroad them into stuff. I got to go back to my disclosure. This was a sponsored episode, and I'm not here to provide financial advice. But if something resonated, don't rush into things. The great basketball coach John Wooden said, always be fast, never hurry. Go investigate it with the same care you might bring to a difficult diagnosis or deciding on a procedure. Pull up the verified numbers, read the fine print, and take your time. And Jeff just mentioned the page that he set up for our listeners. It's start.nurp.com/doctors. That's start.nurp, spelled NURP, all lowercase, .com/doctors. And you can see how it works with your money staying right where it is prior to putting any actual money in. Monopoly, Circle, TM money instead. Thanks so much for spending this time with me, both to you and to the listeners. Take care of yourself so you can keep taking care of the people who need you. I'm Dr. Jonathan Winkle, and this is Healing People, Not Patients. Thanks for spending time with me today. If this conversation sparked something in you, subscribe so you don't miss the next one. And share it with a colleague who could use a reminder of why we do this work. For more thoughts, explore my blog at www.healerswholisten.com/blog or follow me on Instagram at healerswholisten. For deeper dives, check out the book version of Healing People, Not Patients, or my second book, From Illness to Exodus. Links to both are in the show notes. Our theme song, Room for the Soul, is available on Bandcamp. It's a reminder that together, we can find room for the soul in medicine. This podcast is not medical advice, nor is it legal or financial counsel. It's a space for reflection, rooted in stories, spirituality, and the art of healing. For your own care, always consult the professionals who know you best.